What if I told you there's an investing mistake so dangerous, you'll never see it on any brokerage statement? You'll never get an alert about it. No financial news channel will warn you. And right now, it might be quietly destroying more of your wealth than any stock market crash ever could. Welcome back to the Daily Investor. Today, we're talking about the concept of opportunity cost, and more specifically, why ignoring it is the single most expensive habit in all of investing. This isn't some abstract economics textbook idea. Warren Buffett has called his own failure to account for opportunity cost a multi-billion-dollar mistake. And if it can catch him, it can catch any of us. Let me show you exactly how this works, and how to make sure it's not silently draining your portfolio. Opportunity cost is simple in theory. Every time you put a dollar somewhere, you're choosing not to put it somewhere else. That choice has a price, even if you never see a bill for it. Let me make this concrete. Imagine it's 1996. You have $100,000. You're nervous about the stock market, so you park it in a savings account earning about 2% annually. Feels safe. Feels responsible. 30 years later, in 2026, that $100,000 has grown to about $181,000. Not bad, you might think. But here's what you never saw on any statement. If you had put that same $100,000 into a simple S&P 500 index fund averaging 10% annually, you'd have roughly $1,745,000. The difference, over $1.5 million, is pure opportunity cost. You didn't lose $1.5 million. You never had it. It never showed up as a loss. No red numbers. No margin call. It just quietly never happened. And that's what makes opportunity cost so dangerous. Losses are loud. They show up in red on your screen. They make the news. But the gains you missed? Those are completely silent. As the saying goes in economics, there's no invoice for the road not taken. Now, this is educational content, not financial advice. Markets are unpredictable, and past returns don't guarantee future results. But the math of compounding is unforgiving to capital that sits idle. Understanding that is the first step. If you think opportunity cost only matters for small investors, let me tell you a story about Warren Buffett himself. In 1966, Buffett's investment partnership purchased roughly 5% of the Walt Disney Company. The price? About $4 million. At the time, Disney had just released The Jungle Book, the theme parks were booming, and Walt Disney himself was still running the company. Buffett saw the value. He understood the brand. Then, just about a year later, he sold the entire position for around $6 million. A 50% gain in roughly 12 months. By any normal standard, that's a fantastic investment. Buffett made $2 million in profit and moved on. But here's where opportunity cost enters the picture. Disney went on to become one of the greatest compounding machines in corporate history. They acquired ABC and Capital Cities in 1996, Pixar in 2006, Marvel in 2009, Lucasfilm in 2012, and 21st Century Fox in 2019. Through decades of splits and growth, that original stake, the one Buffett sold for $6 million, would likely be worth several billion dollars today. Buffett himself has acknowledged this as one of the great opportunity cost mistakes of his career. He didn't lose money on Disney. He made a 50% return. But the cost of selling early was measured in billions, not millions. The $2 million he gained was dwarfed by the billions he left on the table. The lesson here isn't that you should never sell. It's that measuring success only by what you gained completely ignores what you gave up. And sometimes, what you gave up was worth far more. Now, there's a specific way that opportunity cost devastates portfolios, and almost every investor falls into it at some point. I call it the get back to even trap. Here's how it works. You buy a stock. It drops 50%. Instead of honestly evaluating whether your capital would be better deployed elsewhere, you hold on and tell yourself you'll sell once you get back to your purchase price. The problem is that while you're waiting to get back to even, the rest of the market is moving on without you. No example illustrates this better than General Electric. In August of 2000, GE was the most valuable company on the planet, with a market capitalization over $600 billion. It was the bluest of blue chips, a staple of every retirement portfolio, and an original component of the Dow Jones Industrial Average. Then the decline began. And it never really stopped. By June of 2018, after more than a century in the Dow, GE was removed from the index. Its market cap had fallen below $115 billion. Now think about the investor who bought $100,000 of GE at the peak. By 2018, that position was worth roughly $20,000 to $25,000. An 80% decline. That's painful enough on its own. But the real devastation is the opportunity cost. That same $100,000 in a simple S&P 500 index fund, even after the dot-com crash and the 2008 financial crisis, would have grown to roughly $230,000 over the same period. The gap isn't just the $78,000 loss on GE. It's the $208,000 total difference between where you ended up and where you could have been. Peter Lynch put it best when he said selling your winners and holding your losers is like cutting the flowers and watering the weeds. Every day you hold a declining stock while waiting to get back to even, you're actively choosing to miss gains happening elsewhere. That is a decision, even if it doesn't feel like one. So how do you actually protect yourself from opportunity cost? Here's a practical exercise I recommend doing at least once a year. I call it the blank page test. Imagine you woke up tomorrow and your entire portfolio was converted to cash. You have the same amount of money, but no positions. Now, with a completely clean slate, ask yourself one question for every stock you currently own: would I buy this today, at today's price, with today's information? If the answer is yes, great. That holding is earning its place. But if the answer is no, you need to be honest with yourself. Because holding a stock you wouldn't buy today is functionally the same as buying it today. Every day you choose not to sell is a day you choose to reinvest at the current price. The original price you paid is irrelevant. That's a sunk cost. The only question that matters is, what is the best use of this capital going forward? Buffett applies the same logic at Berkshire Hathaway. In his 1996 letter to shareholders, he wrote that his job is to allocate capital to wherever it will generate the highest long-term return. Not to be loyal to past decisions. Not to prove a thesis right. Not to wait to get back to even. Simply to put every dollar where it works hardest. This is not about trading constantly. It's not about chasing the latest hot stock. Value investors are patient by nature. But patience should be applied to great businesses bought at fair prices, not to broken theses you're too anchored to let go. If you remember one thing from today's video, let it be this. Buffett once wrote, "Should you find yourself in a chronically leaking boat, energy devoted to changing vessels is likely to be more productive than energy devoted to patching leaks." The most expensive investment you will ever make isn't the one that crashes. It's the one that goes nowhere while everything else grows. Losses scream at you from your brokerage statement. Opportunity costs whisper. And the things that whisper are almost always more expensive in the end. Run the blank page test on your portfolio. Be honest about what you find. Your future self will thank you. If this video changed how you think about what's really in your portfolio, hit that subscribe button. We put out a new video every single day to help you become a smarter, more disciplined investor. And drop a comment below. Have you ever held a stock too long because you were waiting to get back to even? I'd love to hear your story. Tomorrow, we're diving into the history of the 2008 financial crisis and the investors who saw it coming. You won't want to miss it.